Welcome back to Today Daily Analysis for the 4th of September, starting with the US dollar index, which remains flat. Has the US market reopened after the Labor Day holiday, with the S&P PMI data bringing no surprises. The US dollar index held steady above 101.5 after gaining over 1% last week. This week, the market's focus shifts to key labor data, including the August employment report on Friday, which could show a strong rise in non farm payrolls and potentially supporting the dollar. Although the economic growth is stronger than expected, the market may be overestimating the likelihood of aggressive Fed rate cuts. A rate cut in September is likely, but the extent will depend on this week's data. And for the US dollar, remains above 101 with the market eyeing important data such as the job opening, ADP employment, and the ISM service data ahead of the Friday's report. The dollar movement will depend on whether the data exceeds full or shorts, which meets the expectations. The key resistance levels are 101.98 and 102, and further resistance at 102.65 and 102.85, while the support lies at 101, with a potential drop at 100.51 if broken, and possibly further to the psychological level of 100. And next, for the WTI crude oil, the traded around 71 on Tuesday, slightly above the previous day's level. After a sharp 5% drop, the decline was driven by the concerns over the China's slowing manufacturing activity in August, which pressured the oil prices. However, the disrupted oil supply from Libya, where clashes have halted the production, will limit the further downside. While China economic slowdown have raised concerns about the oil demand, the situation in Libya could provide temporary support for the prices. Although these disruptions might prompt OPEC Plus to increase supply, the impact is expected to be short-lived. Additionally, the Fed potential interest rate cuts can support the oil prices by boosting the economy activities and the demand. The market sentiment remains weak due to the demand concerns from US and China, Libya partially oil facility reopening, and the OPEC Plus decisions to increase production in October. The technical indicators such as the week 14-day RSI suggesting a very short-term outlook for the WTI prices. The prices have fallen at the key levels below 72.1 and 72.08, with potential to test support at 70 and 69.18. On the upside, the resistance starts at 75.44, with further limits at 77.81, and the 200-day moving average at 78.04, keeping the broader bearish trend in play. And lastly, for the gold prices, continue to decline on Tuesday, reaching their lowest level in nearly 2 weeks, trading below 2475. Despite a drop in the US Treasury yields to 3.8%, the gold struggled to gain grounds due to the strong US dollar. The market remains focused on the upcoming US report, which could influence the Fed rate's decisions on the sides of its September rate cuts. Although the gold prices are under pressure, expectations of the Fed rate cuts and ongoing geopolitical tensions in the Middle East could provide support for the precious metals. The highlight of the week will be the US non farm payrolls data for August, which could significantly impact the gold prices in the short term. And then for the technical side, the gold remains above the 25-day key moving average of 2,473, maintaining a bullish outlook. The 14-day RSI is above the midline at around 55.5, suggesting that the upward momentum is more likely than a reversal. The key resistance is around 2,530 to 2,540 range, with potential to further rise at 2,544 if this level is breached. If the gold breaks above and confirms support at these levels, it could target 2,578.2 or even 2,600. On the downside, the initial support lies at 2,473 and 2,470. A break below these could push the gold down to 2432, the low from August 15. And that is all for today daily analysis. Thank you for watching and happy trading.